Bitcoin and other cryptocurrencies have transformed conventional banking structures and presented regulatory difficulties to governments all over the globe. Governments must decide how to effectively regulate new payment technologies in order to safeguard investors from scams as Bitcoin becomes more and more popular. To understand how it can impact investors, it is crucial to assess the current legal and regulatory environment of cryptocurrencies. This paper discusses the legal landscape of cryptocurrency regulations across the globe. It starts with a history of regulation in the U.S., outlining how both the federal government and several states have controlled cryptocurrencies. However, regulatory frameworks differ greatly across countries, and cryptocurrencies are not subject to any one legal system. As a result, the paper will discuss cryptocurrency laws in several nations, with a focus on China and the European Union. The effects of these rules on prospective Bitcoin investors are then taken into account. The first cryptocurrency appeared in 2009 with the publication of the initial version of the Bitcoin software by an unidentified developer using the moniker Satoshi Nakamoto. Over the next 10 years, the number of digital currencies exploded, with over 5,000 new tokens being released in only 2021. Governments hurried to enact laws that would assist to control cryptocurrencies' rising popularity and data security as the market for them exploded in size and volume. Now reaching a whopping $2 trillion market capitalization, the Financial Crimes Enforcement Network's 2013 guideline on virtual currencies, which took the initiative to alert prospective investors to the related dangers, was the first federal statute in the U.S. to address cryptocurrencies. Since then, opinions on these tokens have fast changed from indifference to complete faith in using the blockchain technology that powers them, to the point that some states have introduced cryptocurrency laws to their respective legislatures. The IRS classified Bitcoin as property rather than an intangible asset in 2015, making it taxable. By 2021, the majority of U.S. states will have regulations requiring sign-up procedures for cryptocurrency exchanges, since these digital currencies will be regarded legally as securities by these jurisdictions. Prudent safeguards were put in place to stop illegal or fraudulent conduct and provide investors with asset protection, such as the proactive engagement of U.S. authorities like the CFTC and SATC. Despite the advancements made in the U.S., very few nations have developed a sound framework for the legal regulation of cryptocurrencies. Most defiant affluent nations continue to be seen as domains where states are either opposed to such technology or very sluggish to respond, particularly in Asia, to technology's categorization and treatment. As a result, buyers and sellers of digital currencies in the aforementioned geographic areas are further burying themselves in the shadows, since there is little to no regulation protecting them against fraud, theft of cash, and other unapproved activities. However, authorities throughout the globe have started to take efforts toward providing stronger levels of safety for the benefit of all parties involved. This absence of regulation exposes the buyers and sellers of digital currencies to some danger. Notable aspect of the European Union's extensive legislative participation is the emergence of several regulations and investor/consumer protection guidelines that expressly mention blockchain assets and virtual/crypto assets. Recently, the European Union Commission passed Article 189 of the Capital Market Union, CMU, into law, which is a complement to the current securities regulations in the EU. A number of digital currency-related principles are formally recognized by Article 189, including 1. Greater trust in financial institutions engaging in crypto asset activities. 2. The need for safeguards to ensure fairness to parties involved in the transaction. And 3. The requirement that digital asset services adhere to the same stringent standards as other securities laws. Derivatives of cryptocurrencies are specifically excluded from the definition of transferable securities in MiFID per Article 189. As a consequence, the obligations of MiFID regarding market transparency and routing supervisory procedures do not apply to businesses providing cryptocurrency trading services or to clients who are legitimately in possession of digital currencies downstream. The implementation of a reliable registration procedure as a protection against risks and duties being transferred to the incorrect jurisdictions was a noteworthy Article 189 advancement. As a result, in contrast to the frequently observed minimal cryptocurrency regulations, the European Union has established numerous foreign-level laws with extensive safety measures that demand virtual asset firms to comply with internal resource and system requirements set by the ECB, obtain authorization to operate legally, and have adequate capital. China is severely lagging behind the worldwide advancement in cryptocurrency rules, directly contradicting the EU's proactive action. China's strict laws restrict any purpose of taxable crypto sector investment operations from China. The People's Bank of China has had its own cryptocurrencies prohibited, despite the fact that their anticipated debut had already garnered media attention in early 2017. China's banks have not just refused to allow for any cryptocurrency deposits in the first instance. Due to its historical position constraining capital market openness and stringent financial rules that constantly impose outlandish bans and barriers against unacceptable activity, China has taken an almost hostile approach against these currencies. The PBOC maintained its stronghold status with various prohibitions on investments in the virtual currency, including banks and payments establishments shutting down their services for transactions in any form of cryptocurrencies, further tightening the government's stance on virtual asset legal standing over the months that followed 2021, over the numerous ban instances against the altcoin cryptos, Bitcoin, and other well-known public currencies. Nevertheless, despite the government's laissez-faire attitude toward regulation, what had seemed to be missing from Chinese markets has been replaced with a more lively strategy, although one that has been unwillingly embraced owing to the absence of a formal national digital currency system. Currently, any kind of legitimate Bitcoin transaction is a peer-to-peer, P2P, activity since it lacks legally recognized professional or institutional oversight, which negates any obligations to adhere to local laws and relevant local or international punishments. As many as 300 blockchain initiatives have since lost funding, including initial startup funding and seed investments from the Chinese state, due to alleged reasons such as covert airing of financial criminality embedded and slash or Moochmet-related links, or illegal Securith Sol options related to those Patricks. These regulations, however, come fast and loose as dozens of blockchain-related projects gained official support through innovation zones only this year. Potential investors must do extensive due diligence before investing owing to the wide variation of laws governing cryptocurrencies across the world. Before investing in cryptocurrencies, one must understand that these assets are still quite erratic in nature and that trading or investment experience is necessary. Governments from all over the globe have put in place particular rules to make investing in cryptocurrencies safe and prevent evil deeds that may arise from the usage of virtual money. Additionally, it is crucial to understand that cross-border trade, a key aspect of the cryptocurrency market, is more difficult and, in some instances, even illegal as a result of the discriminating restrictions required by governments throughout the globe. When it comes to engaging in any kind of international trade, investors should be aware of their misgivings. In conclusion, creating appropriate rules particularly designed for cryptocurrencies is a vital but challenging undertaking, and markets won't be fully developed for some time. Investors are fully accountable for their decisions and investments. Understanding the legal environment and what it implies for investing in these markets is important for individual success within any particular jurisdiction as crypto assets advance and grow over the next years. Even when the laws seem to be slightly less than ideal, it is crucial to research the applicable laws and take steps to adopt a responsible attitude toward drinking water and other materials. This is especially important when participating in any type of cryptocurrency-related trade or business. This is it for today's video. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe to our channel, The Crypto World, for more future updates. Thanks for watching.